Steve Live. I'm SmallCapSteve. Today we've got the folks at Spot Gamma coming on, talking to us about all that fun option trading stuff, Gamma, Delta, first derivative, second derivative. Your head's going to be spinning, but we're going to try to make it really simple for you to understand and take a look at how changes in the price of options can affect the underlying securities and ultimately, create different market moves. Then later on the show, me and Jay are going to get into some of the Canadian venture and small cap news. So buckle up. We're getting started. Hey, so I got the folks here at let's try to find a bit of a better view. There we go. This one works. So we got the Spot Gamma guys up top, the deep dive guys down on the bottom here. How's everybody doing today?
I'm doing great. Thanks for asking. Thanks for having us on.
Great to be with you.
So we got Brent and Matt from SpotGamma.com, which is a service that tries to make it very easy for retail investors to understand some of the complex sort of movements in option pricing. So guys, first off, before I got a list of questions here to get into, we had you guys on before, but what was the whole reasoning that you guys started Spot Gamma?
Yeah, sure. So I come from an investment banking background. I was a broker for a while at a few big banks, and I went to a family office eventually and built options models. And I found that the options models had a great predictive ability, basically, in terms of how stock prices would move. So based on that and those models, I decided to start sharing that with everybody. And that was kind of the real quick and dirty summary of Spot Gamma and how it came to be. Basically, it modeled my own, created my own options models and decided to make them available for the general public.
Okay, so let's sort of get into it here. Can you guys describe your approach? And is it more based on fundamentals or technicals? How does it work?
Yeah, we would classify it as a technical approach because we don't look at earnings or what sales growth will be next year or anything like that. All of our predictions in terms of support and resistance for stocks is based off of where options are positioned for that stock. So based on the options flows and where new call and put contracts come in and expire and the like, is how we base off our predictions of how those various stocks will move, what support and resistance is.
So we'd say that it's effectively technicals.
Right. Right. So if you go to our site and you look at some of our data, we'll tell you where we think a stock is going to get support and resistance. So sort of the same way that you would look at a chart and say, okay, there's a 200-day moving average, or this is the previous high or something like that. It basically can be the same thing, right? If there's a lot of open interest at a certain strike or a certain price in the stock, we think that'll be support or resistance, and we kind of try to make that very transparent to people on our site.
Okay. Matt, you got anything to add?
No, I think Brent summed it up well. We're really trying to make it very accessible so you can come to our site. You don't have to understand options. So the goal for us is to be able to explain to any of our users, if you want to be invested in the traditional stock market, where are buyers and sellers entering? And by looking at our charts and graphs, again, you don't have to have any level of sophistication around options. We think we provide valuable insights.
Okay. So for our viewers who trade equities, let's just start off real basic here. What are options and why are they important for sort of retail investors to understand and take a look at?
Sure. So so there's two types of options. There's call options and put options. And when you buy a call option, you're making a bet that a stock is going to go up. And when you buy a put option, you're making a bet that a stock is going to go down or go lower. And it allows you to invest in a stock or invest in the price of an underlying for a fraction of the cost of actually buying shares, right? So that's essentially what an option is. And what's been interesting in the last couple of months is that the amount of options trading that's taken place in markets has accelerated exponentially. There's record volumes, nearly every week and every month. And so even if you don't want to pay attention, or you're not an options trader, so to speak, the effect of all that options volume is having major impacts on all sorts of different stocks. So our kind of thought is that you can't really sort of ignore what's happening in options, even if you don't trade them at all, because the effect of all this options trading is impacting all these different stocks, and it behooves everyone to really understand that. All that flow.
Would that be largely because of like Robinhood and some of these apps that make it easily accessible for retail investors?
Yeah, 100%. So if you just think about what happens when you buy a call option, most people think that when you buy an option on an exchange, or you go into Robinhood and buy an option order, that there's somebody else, like yourself, sitting on the other side, and that I'm trading with you, for example, Steve, as a retail trader. But what you're actually doing is you're trading against a market maker, right? You're trading against a big entity of some type, and so they need to hedge their risk, and when they do that, they buy or sell the individual stock. So it really boils down to be something very simple, right? If we all buy call options, market makers who are on the other side of all these orders have to buy stock, and if we all buy put options, market makers have to sell stock. And so if you think about everybody on Robinhood buying tens of thousands of call options in, say, GameStop every day, well, that market makers, or the people on the other side of the options trades, have to buy stock to hedge themselves, and that makes the price of the stock go up.
So if we're thinking of it this way, right? Like I'm a retail investor. I'm on Robinhood or Webull or whatever those apps are called in the US and Canada. We have Wealthsimple, which I don't think they give retail investors access to options, but we're buying options, like in the case of GameStop, because the more options we buy, the more the market maker has to cover, and the more it drives the stock price up. Right. What's my is my risk effectively my biggest risk as a retail investor who's buying these options? They're probably pretty overpriced, but I'm buying them anyways because I think it's going to go up. Is my greatest risk that retail investors are going to stop buying these options?
Well, that's sort of been the interesting thing that changed really with GameStop, was that originally people would buy an option because they thought the stock was, going to go up because, maybe, for example, Tesla is going to release a new car, or the new iPhone sales are going to be great, or something like that, right? And you would bet on the stock going up because of some fundamental driver, maybe. And with GameStop, it was clear that the retail public started to understand that if we all get together and we all buy calls in GameStop, we can force the stock higher because we're making market makers buy stock, right? We're making another entity hedge, and that hedge is buying stock. So again, all these GameStop traders buy calls. That means market makers like Citadel, these kind of household names now, they're buying stock, and we're forcing the stock up higher by buying calls. And so they kind of understood that collectively they can sort of force the stock higher, with that, via hedging, basically, if that makes sense.
So what I'm interested in is, with the rise in options as a whole over the course of the last year, how has that impacted what you guys do specifically? Has it made your predictions easier or harder to make based on all this volume that the model wasn't created with?
Yeah, it's made it in a lot of ways easier, because if you just think about what it boils down to is just volume, right? When you look at any stock, you know how much volume trades on an average day. And the more options that trade on that same stock, the more hedging volume has to take place. And so if we have, let's say, an average stock trades 1 million shares a day in stock, right? If a million call options trade today in that same stock, the hedging flows are going to overwhelm the regular stock volume. So you can kind of then predict with more accuracy what's going to happen to the stock, because we know that the hedging volume in that stock is so high. Hopefully that makes sense. So in other words, the options start to control the way the stock trades.
Here's a question that's coming in. We'll give this one to Matt. So this comes from Boss Run the Game. You buy calls, then the stock goes up?
Sure. Yeah, and Brent can go into the technical details behind it, but conceptually the answer is that what Brent is answering is, when somebody buys call options, so if you were to buy call options, there's a market maker or a professional who is selling you those call options. They don't take directional risk. So what happens is, when they sell you the call options that you're buying, they hedge by buying stock. So it becomes a bit of a snowball effect, that when you are buying your call options, they're selling you call options and they're buying stock. So what Brent's explaining is that what we analyze is what is that reflexive buying pressure that takes place in the market. And to answer the broader question, and Brent did a good job of that, and over the past 3 years, there's been a tremendous increase in options traded, the total volume both on indices and individual stocks. So our fundamental belief is you really cannot ignore the underlying number of options that are trading anymore because they are moving stocks.
So I think one thing that I would like to add to that, just for some clarity, is if I were to go and buy one call option, it's not going to have all that much of an impact, right? Because it's a small amount that needs to be hedged against. It really starts to drive things, and that's where my understanding of spot gamma as a whole is the more volume that goes, the more hedging has to occur, and that's what causes the price to rise. So again, me as a retail investor, if I go buy one call option, it's probably not going to have an impact.
That's right.
But it's going to have an impact when it's done in size. Now, whether that's me as a hedge fund doing it in size or me and a ton of people, such as we saw in GameStop, doing it.
Exactly, that's exactly right. So over the summer was kind of the first time that people started to talk about this, because I don't know if you are familiar with SoftBank, but SoftBank bought all sorts of call spreads, right? And people were blaming them for, driving the market higher because of this options effect we're talking about. And so it's such a, it's an interesting thing now that retail has grabbed on and taken hold of that. And we could tell just by our subscriber base that people come in every day and they want to know which names now have large options volume so that they can get in front of the next GameStop, right? Like front running, so to speak, the next big options, options name is kind of in vogue right now. It's what everyone wants to do.
But to Brent's point, the more options trade, the better our models are. So this only helps us, this continued enthusiasm.
Okay, so talking just sort of options, you're an investor. What's worth actually analyzing here?
Sure. So there's two things you want to look at when you're buying an option, buying a stock. You look at the options. One, you want to look at what's called open interest, and open interest tells you how many contracts exist for a current stock. And so you want that to be something sufficient, right? You want to see tens of thousands, if not 100,000 or so, calls in your name. And then the other one is options, the daily options volume. You want to see like a weighted, you want to see call weighted volume, and call weighted volume, or even put weighted volume, will tell you that there are investors trying to buy calls, which is going to sort of get market makers having to buy stock to kind of get the juices flowing, so to speak, if that makes sense. So again, you want to look at what the current options position is versus open interest. And then the daily call volume is telling you that there's activity, there's call-based options activity taking place, and that can kind of start to signal to you that this kind of options-based ramp is picking up.
Okay, let me peel that back a little bit there. So
Sure.
you said current option position versus open interest. What do you mean by current option position?
Yep. So if any name that you look at in your brokerage system or on Spot Gamma, you'll see that there's something called open interest, and the open interest tells you how many contracts exist in a certain stock. So you can tell they tell you the number of call contracts that exist and the number of put contracts that exist. That's called open interest. And so you can tell that if there's, for example, 1 million call open interest versus only 200,000 put open interest, you can tell that there's way more investors sitting right now long call options, and that is giving you some information about how the stock might react if the stock starts to move up, right? Because if the stock starts to move up, you know that there's market makers that have to hedge. And you know that because that open interest figure of 1 million is so much larger than, say, the put open interest of only 200,000.
Okay, got it. So, so next question here: does this work for all stocks, and over what periods of time is there value in this?
Sure. It does not work for all stocks, right? You need to make sure that there's a significant amount of options volume trading in that name. So if you were to look at, again, options volume in a name, daily options volume, or open interest, if that open interest isn't significant, meaning if it's not several 100,000 contracts, then typically that means that the options aren't going to have much of an impact. Just to give you an idea, if you look at GameStop, that market cap of that stock was $48 million. I mean, it's a very small company, but so far in 2021, it's the 10th most active options trading name out of all 4,500 stocks that are trading in the United States. So that's massive, massive options volume. And the larger, again, the volume in options is, the more sort of the more validity this options data or our options levels, provide. So to answer your question again, make sure that you're seeing generally 10, 20, 30,000, volume at least, daily volume in calls and puts, and then an open interest of, again, 10, 20, 30, 40,000 at least.
Okay, got it. So let's take a look at some examples here. We've got Tesla. Let's start off with Tesla.
Sure. So we're going to be showing this in what we call our Equity Hub trading tool. So you can look at all 3,500 different stocks in the United States, and what you'll basically see here is this graph tells you where the options positions are most concentrated. So can you guys see this?
We have TLRY up. Did you want to look at TLRY or do you want to look at Tesla, Steve?
Yeah, just change Tesla.
Yeah, let's start with Tesla because someone actually asked for sorry, let's start with TLRY. Somebody asked for TLRY. We'll just go with it. We got TLRY up. Let's start with TLRY.
Okay.
Great.
Hopefully we're sharing okay here. So TLRY has been interesting because the options volume in the stock has been very high. And you can see a few things. One, we talked about the open interest. So if you see the second or third column in here, you can see call total, tells you how much call volume there is or call open interest there is. It's 600,000 contracts calls and 485,000 contracts and puts. So that's pretty big volume for a small cap stock. As you guys know, TLRY is doesn't have a very big market cap. And the bulk of those positions are tied to let's see here, 25, right? So 25 is sort of what we consider a support level in the stock. And then what you can also see is that the other big area of open interest or where calls are positioned is the 30 strike. And those look like call options. So what that is telling us is that as the stock goes from 25 up into 30, that market makers likely have to start buying stock. And that's why you can get some of these big ramps in TLRY. Like if you've seen it trade over the last several days, you kind of get these real explosions upward in the stock price, and then it'll sort of drift back down and then sort of explode back up.
Can you pan down just a little bit? The graph's not quite fitting in the view.
Sure. There we go.
There you go.
Okay. So TLRY stock right now is trading at $32.
Yep.
And so that's I guess PX. And we have the key gamma strike at 30, the hedge wall at, it looks like 25. So walk us through what all of this means and how this is of value to somebody who's trying to assess a trade on TLRY.
Sure. So the key thing to note is that all the levels that you see on here are support and resistance levels. And so all you need to know fundamentally is that there's support at 25 because of these big options positions. And then there's resistance around the 30 area. Now the stock opened up a little bit higher than that today. So this 30 area now becomes a support level. But fundamentally what you know is because there's such a large call position, right? What we're trying to do is identify stocks that can really take off because of market maker hedging activity. You know that as the stock pushes into 30, because of this big gamma area, is gamma we can explain in a second, because of this big gamma area, that's telling you that market makers will have to start buying stock as the stock gets over this 30 line. So the fact that you could see that there's this, what we call the volatility metric, our momentum indicator, the fact that this starts to drop down and eventually it turns green is telling you again that this is a bullish move that the stock is positioned for. And that's strictly due to the market making hedging flows.
Okay, so I'm looking at this as sort of the SG momentum indicator. That would be like our y-axis here is like the gamma number.
Right. So another way to think of that simply is how much hedging activity could impact the name. So the higher our momentum indicator is, the more activity or the more of an influence market maker hedging has.
Okay, so now we're obviously seeing, a series of linear set or line segments that are consistently downward sloping. That means that we're going to get less momentum. Like if I'm working with, I got a Reddit group with 100,000 people in it. We're trying to figure out, okay, what stock do we want to bully next? It looks like the market maker is not going to work in our favor in this one because it keeps moving downwards. Would that be?
Yeah, so this picture will change every day, and so for today, you're right that there's not a lot of open interest over the 30 area, right? There's not a lot of open interest over the 30 strike, we'd call it, and we know that because all of our metrics are down lower here in the 25 area. And so, what the other interesting thing to note here is to talk a little bit about expiration. Every Friday, there's an expiration for most stocks, and what happens on this Friday? It's a very large, what we call a monthly expiration. And 56% of the position in TLRY in terms of options expires today at 4 p.m. So that means that the bulk of this options position that we're looking at here is
tomorrow.
Tomorrow at 4 p.m. Forget what day it is. Tomorrow at 4 p.m. So the bulk of this options position is going to be removed essentially, right? It's going to expire. And so the flows now in TLRY, as far as dealers are concerned, are really tied to that expiration because, again, it is such a large expiration as you can see noted here. So the effect of that is that market makers are hedging tied to the big open interest area, which in this case is 30, right? Because the stock's at 31.93 right now. So what we would estimate would happen is that this 30 strike area, which is very important to the stock right now, as you can see in the chart, the stocks are on 31.
Can we scroll down a little?
Yep.
There we go. Perfect.
So the 30 area is very important to the stock today, the 30 strike. On Friday night, that pin, so to speak, that hedging area is depreciated, right? Because of all these options expire. So now the stock can have more volatility next week, right? The stock can move out of this price range because all of those options are expiring. So we think about big options positions as almost like a pin, right? And if the pin is pulled, like it will be on Friday night, then the stock is free to move.
Yeah,
so if I understand, sorry, go ahead.
I was going to say, Steve, to what you said, Steve, what you said was incredibly accurate. So this is not the kind of stock you would want to try to jam today if you were those Reddit traders. $30 is now that support where buyers would come in, and that higher line of 34 is your resistance. So you're in that corridor there, and momentum increases as it goes up to 30, then it would sit. But if it broke down below 30, downward, it would accelerate to the downside. So that's what this setup is telling you. And as Brent said, this resets every night. We refresh our updates every single day. And then every Friday when these options expire, you could have a totally new key gamma strike depending on activity. But as Brent showed, the open interest is really high going into this Friday. So that's you understand it exactly the way you described it.
So I want to make sure that I'm understanding this correctly. So key gamma strike is at $30, and then it looks like volatility it ramps up if we fall below $30 because
correct
hedges will start to be sold off.
So
is that correct?
Yeah, so there's two colors on this chart, right? There's this big red area and there's a big green area. Red is telling you where most of the puts are positioned. So the stock right now is at 32, right? And it's in this big red area, which is telling you that more put positions exist around current prices than calls. So the reason that volatility would move higher, as you pointed out, is because when the stock moves lower, puts gain more value, which means that there's more hedging flows related to those options. Does that make sense?
Yes.
And if we get above 34, that is where the calls really kick in, right? That's where it goes from puts kind of dominating the name to calls, and we know that the hedging activity materially changes. So you can make a case maybe that you don't want to get long the stock until 34 because it's over 34 where that what we would call the gamma squeeze, right? Where call gamma would pick up and market makers would start buying the stock.
And that last point's the really important one. So if you're just trading TLRY and you're ignoring the options, you would open up this chart in the morning, see that at 34 and above, it's a lot safer to be long because calls are going to control the name. And below 34, you're at the whim a bit more of some of the put pressure and the downside pressure. So that's the big takeaway from this chart.
Okay, so just from high level, you look at this chart this morning, you wake up, and again, nothing we're talking about here is a buy or sell recommendation.
Right.
This is just informational purposes only. We're just trying to understand, probability, statistics, those sorts of things.
Yep.
I wake up, I look at this chart, I'm thinking if gun to your head, long or short, you're going to choose going short the stock.
Yeah, I would short down to 30 at 30 because of this big gamma area, which is key gamma strike is at 30, which is we believe is like a pin level into Friday night. That I would be short into that 30 price area.
Okay.
So when Brent says pin, Steve, he's saying it's almost like a magnet. So
Right.
again, we're not making any trade recommendations. These are just educational financial insights. But an aggressive short-term trader heading into Friday might even sell some out-of-the-money calls and puts. They might sell the 28 put line and the 32 call line, assuming or hoping it pins 30 by what the setup's showing you right now. But again, not something we recommend doing.
Okay, got it. Okay, so let's move on to the next one. Let's do Tesla.
Yeah, Tesla's one that really respects big options levels because there is so much trading activity, in the name in terms of options. So you can see here that all of our levels in Tesla align directly at the 800 strike, right? The 800 strike for options, in Tesla is a huge level, and the stock has really been hugging that level over the last week. And again, the Friday expiration, meaning the expiration for tomorrow night, is a big one in Tesla, and it's actually where 50% we calculate 50% of the overall stock position in U.S. equities. 50% of the overall options position expires on Friday night. So there's a lot of names that have big options positions that expire tomorrow night, and that leads to more volatility taking place, next week, really.
Okay. So
and two quick points to make there, Steve, if okay, is as Brent mentioned before, every Friday these names often have options expire. However, the third Friday of the month is when the largest amount of options expire across all names and indices. So this is usually the biggest resetting, and sometimes some of the most violent moves take place. And again, secondly, as Brent said, all those lines being at 800 does act as a bit of a pin or a magnet heading into expiration because there's so much outstanding options around that. But all the hedging will kind of center around that line, or could center on that line.
Right. So if I'll show you something else here. We have a 5-day history, and so you can look at where the areas are over the last 5 days, and you can see that the 800 strike really has been over the last several days in play here, right? Over the last multiple days in all of our different metrics. And the amount of options gamma has, the size of the option position that expires this Friday has only increased on a percentage basis. It was 30% at the beginning of this week. Now 40% of the total options position expires again on Friday. So that means that the magnitude or the importance of this 800 level into tomorrow's night's close has only increased. And if you look at how the stock has been trading, you can see that the 800 price level has been very important to the stock, right? It's a level that continuously comes into play over the last several days. So if you see here, this is the 800 price level, as you can see on this chart here, and you can see how the stock has bounced off that level. It seems to move away and then immediately come drawn back in. Yesterday morning the stock opened very weak. It traded down to 770. It closed right at 800. Today it opened down weak again, right? It opened around 780, and it appears to be trending back up into that 800 price level. So, this is a great example. This is a name that really starts to move to where the big options positions are.
And Steve, not to do any kind of not a sales plug, but on the free educational portion of our site under the FAQ tab, we did a case study on Tesla. So our fourth video called Advanced, we walked through what happened when they were added to the S&P. So we put out a note then that said it should pin 500 over the course of the next week. The stock closed right around there. Then for the next month, we could see the setup was going to go to 600, and it followed that again. So options really are dominating and controlling these names. So if you're sitting there, as Brent said, watching these intraday moves down to 770 or up to 830, knowing that all of these strikes line up at 800, help somebody understand where the stock is most likely to be by the end of the week.
So if I'm looking at all these different terms you have here, hedge, wall, key delta strike, key gamma strike, pivot, which of those is most likely going to be the magnet that that the price is going to tend to gravitate towards?
Yeah, that's the key gamma strike, and that is because that is telling you where the most active options are positioned. And when we say active, we're talking about hedging position. So where dealers are most concerned with hedging is going to be tied to that strike level.
Okay, that makes sense.
Great question, Steve. So if you know nothing about options and you look for that key gamma strike on the chart, that's the magnet.
Okay.
That makes it easier.
Yeah.
So if we can talk like a quick example. I'll give you an example of why that would be important. Let's say on Monday morning you decide to buy a Tesla 800 call option, right? And I don't know what the price would be. Let's say it's $20, just for sake of argument. When Steve, when you buy that call option for $20, as a market maker, if I'm on the other side of that, I'm now short a call, right? And that means that if the price of Tesla stock goes up, you're making a bunch of money, but I'm losing a bunch of money, right? Because I'm essentially short. I'm a short a call. I'm short the stock. So the way that I would hedge myself would be to buy 100 shares of Tesla stock, as an example. Now, let's say on Wednesday, Tesla stock hasn't really done anything. Your call option has decreased in value, right? Your call option is only worth $10 now, right? You bought it for 20. It's only worth 10. You're very upset because you're losing money. And as a market maker now, because that option is worth less money, I had originally had 100 shares long as my hedge. Maybe I only need 50 shares now, right? Because that option is not worth as much, and the chance of Tesla stock going higher by Friday is much lower. So you can see that each day as the price decays and as Tesla price maybe drifts lower, I can reduce my hedge, right? I can keep selling my hedge. And eventually, tomorrow afternoon, your call is probably going to be worth, let's say, $1, right? And I only need, as a market maker, maybe 5 shares to hedge myself. So I can continue to reduce my hedge into Friday night, tied to that 800 level.
You can sell stock, is what you're saying.
Right, I can sell stock, right.
Would it be fair to say, when I'm looking at these, just the two sort of the shaded areas, I don't know if it's orange and green, but the orange, like when there's a lot more orange than there is green, would it be fair to say that the chart is bearish?
Yes. So what that's telling you is that investors are by and large in put options, because we're in that red-orange zone, right? And so that's giving you some interesting information, I think, about the stock, right? The fact that we're at a price 800, which is more or less embedded in a large, we'll call it put zone, so to speak. That's telling you a lot of investors are inputs in the name, and that's a whole different story from being a very bullish. If we were in the green, it would be a much more bullish stance, right? We could assume that dealers have a more bullish stance, or believe that the price of Tesla could go up.
Okay, so Tesla's market cap right now, on a fundamental basis, I think most reasonable investors would agree makes no sense. I know that's kind of controversial in general, but we're getting near $1 trillion here.
I'm going to go ahead and agree. Yeah, I'll agree. Okay. I see what your point is.
Okay, so I feel like a lot of smart people, and like if you ever want to just nerd out and just read the comments on Seeking Alpha whenever there's a Tesla article, it's all these people just with insights into accounting I've learned, anyways, won't get into all that, but we could have made a case that Tesla was tremendously overvalued at $200 billion. So if I pulled up this chart back then, would it have shown more orange than green?
It would have shown a lot more green than orange, because back then it was all. So what would generally happen with these names is that every Monday people would come in and buy a ton of call options that expired on the next available Friday. And they do that because the call options are cheap, and they started to understand that they could force the stock higher basically every week by just coming in and buying call options. And so, it would happen every single week, and we documented this on our site, and you can see it, that the stock would immediately trade by Friday to wherever the big gamma strike was. And again, that's telling you where the most options are, or the most important sort of options for hedging purposes are. And so the stock would just be in this big green zone every single week, and it would just keep rolling higher and higher and higher. And the tone of the stock changed, right? The tone of the options position changed in the beginning of January. We wrote a big article about this as well. And there's some fundamental things that are a little more advanced in terms of the option position that took place. But we can sort of predict with a fair amount of accuracy, what's happening to Tesla, because the options that trade is so big, relative to the stock's volume.
Okay, but it was a great question. It is. It was much more call dominated. I have friends that are in a poker group with me, and so every week they tell me I'm going to buy more Tesla options on Monday, and I'm going to make $5,000 by Friday. They'd be all excited. And, so
they assume it's an ATM machine, literally. Yeah.
Is there an argument to be made that your service or like your website, and to be clear, guys, we're not getting like paid to have them on. This kind of, in some ways, feels like a little bit like an infomercial, but I'm sincerely just interested in this.
Yeah.
Is there an argument to be made that this tool makes more sense for retail investors than it does for institutional investors?
Well, Brent, let me go first on that one. It's a great question. If you think about stocks in two different buckets, one being really fundamental and one being more narrative stocks, right? As you said, Tesla's really untethered from a valuation perspective. It's not trading on the number of cars being sold. It's a story stock. It's in the narrative category. Retail tends to drift a bit more toward the narrative categories, GameStop, other events. In the fundamental category, we've gotten a lot of feedback from large institutions and banks that also pay for licenses and subscriptions through us, that if somebody has a fundamental thesis and they're saying, well, do I buy TLRY here because I really believe in the fundamentals, or do I feel more comfortable buying it above 34, or should I really wait and make sure it doesn't break 30? They'll call their brokerage house, even if they're trading hundreds of millions of dollars, and say, look at the spot gamma level. I feel more comfortable buying it here because of how the options are set up. So I think it probably on a relative basis helps retail more than an institution because they participate more in narrative stocks. But regardless of being a fundamental or a narrative investor, we really try to give you access to knowing where do buyers enter and where do sellers enter on a 1, 3, 5 day or even a 1 month basis. So if you look out with our stuff 6 months, 12 months, it's not going to be a great indicator, in my opinion. We're really trying to help somebody understand the dynamic around their own narrative or fundamental view. But it's tilted toward retail. That's our goal with the site right now.
This data goes so against everything that has been instilled in retail investors. Like the notion that a stock is a better buy at a higher price than right now. That's where I struggle with this information. That and like in the small cap world, we deal with market makers, absolutely. But we know that at the end of the day, the market maker essentially has to zero out. So when I hear that the market maker has to do all this buying and is actually driving things higher, that's where I've had such a hard time comprehending a lot of this, right? The notion that it's actually the market makers who's supposed to be equal at the end of the day is what's pushing things. It's just different for small cap guys like ourselves. And I don't know about Steve, but that's where I constantly find myself getting hung up with this whole.
Can I try something live, Jay, that might be a terrible idea? If you imagine it's a football game and you're a running back and you've got to get past that defensive line of those big 300-pound guys, right, between 32 and 34. Once you get past them, then you just have the little cornerbacks you got to run over, right? So once you break through those levels of resistance or of sellers, then it's more open playing field to go. So that's kind of what we're trying to show is where are those bigger buckets of buyers or sellers that create those levels of support and resistance. But it's a little counterintuitive, like you said.
You know, that's an actually excellent analogy. And Steve knows I'm the last thing I am is a sports guy, but that actually makes a ton of sense. It's just that's the resistance. And after that, there's so little pushing you down that it's easier to go.
Yeah, you got to get by a guy like Steve, and then you got little me in the backfield. You can run me over.
But I also don't want you to lose the point. You said something key there, right? That market makers have to zero out by the end of the day, and that's the same situation in here in options, right? No one can go home at 4 o'clock with their wrist not squared off. The only difference is that in options, the dealers have to keep hedging on an ongoing basis, right? And we can sort of try to predict those flows is really what we're trying to do, right? We're trying to predict where these big entities are going to start trading, and I think that should be something that makes sense from everybody, right? If you're in a small cap name and you think that Goldman Sachs is going to give a buy recommendation, or Warren Buffett's going to buy the gold name or something like that, you're going to try to get in front of it and predict those that trade before he does it, right?
Can any of your charts be used for some of the commodities? How would you sort of look at it that way?
Yeah, so we've looked at gold and silver and some of those, and we're working on the commodity futures for Q2, probably maybe into Q3. But it works for the ETFs, and so like silver is a really popular one. The options complex in silver is humongous, and we have this giant level, as you can see on our screen here, for SLV, the silver ETF, at 25. And I did an analysis over the summer that showed that the open interest in the SLV ETF dwarfed that of the silver futures. So in other words, from my view, the silver ETF kind of almost wags the future dog, so to speak, in a way, which is kind of counterintuitive. And if you look at the silver price of the SLV ETF, 25 has been the level for at least the last 2 weeks, with all this options position. And it was kind of fascinating over the summer. Like you could see that people would start buying calls, and you could see the call position really build up at the 29.30 level, and the stock really, or the ETF rather, really made a big run, up there. And now it can't seem to kind of move off this pin, right? But that's exactly what it is. There's this big pin area of 25, 30% of which expires on not until March. So March is a bigger expiration for this position. But you can see like there's 8 million call contracts currently outstanding in SLV and only 3.4 million puts. So people are positioned kind of, one way here. And it makes it really interesting.
Now, why wouldn't that result in gamma increasing upwards?
Well, so right, so there's that's a great question, right? Gamma has been increasing upwards, and then seems to sort of be unable to eventually move off of that strike, and so that's what makes the commodity piece so interesting. Are people short SLV and long silver futures? Is there different kind of hedging flows involved with these commodity ETFs, right? There's pieces, particularly I think in oil and the like, that that other influences that come into this position, right? SLV is one of the largest positions in options that exists out of all listed stocks. And I suspect that that's not just bullish investors, right? There's probably a lot of arbitrage that takes place here in the commodity. There's probably a lot of other actors that have sort of not necessarily a directional view, if that makes sense.
So can I make one more quick point, Steve? Sorry. On the last example, what I thought was really important was that things were changing at the end of the day or the end of the week. And so what Brent mentioned here, in addition to seeing the stacking of all those terms at that exact price of 25, he also mentioned the largest open interest is March. So it is really important as well to know your time horizons as to when those things change.
And that's the quarterly expiration, which sort of ties back into sort of there's larger entities and larger players in here, doing different things and just trying to express like a bullish or bearish view.
Okay, so let's assume here that I'm this incredibly wealthy guy. I own.
I assumed that before we even started the call.
It's the neon light, right?
Yeah, it's fancy.
So I want to paint this chart, and I want gamma to accelerate. I want it to tilt upwards. Does that mean that I got to buy a ton of calls way out of the money?
Yeah, so what you're trying to do there is gamma is what you want to do. Gamma is what you're looking to buy. And that tends to be near-term options, so like think 5 days out. And the closer to what we call at the money, which is the option strike that is closest to where the stock is trading, that also has the highest gamma. So again, you want the at the money option with the nearest expiration. That is how you could force the stock sort of up higher. And you want to choose a name that has a lower market cap, right? If you would have to spend an ungodly amount of money to get the SLV or Tesla stock to move, right? But if you were going to go look at like ACB, the pot stock, or maybe some of these silver miners like Hecla or something, you could have a lot more impact there, right? Because it's a smaller cap stock with smaller volume, right? It has lower stock volume. So, if you want to look at, if we look at Hecla, right? It's trading at 6, and it's a bright green picture, right? For those of you who can't see, and
this Brent, this is what Tesla used to look like, or similar.
Right. This is a bright,
really,
it's bright green,
massive green.
Yeah, and bright green is telling you that's a big call position. That's what bright green is telling you, and 6 is the big level in this stock, right? So if I wanted to force this thing to start going higher, and I had big funds, I would start pounding on Monday morning. I would start buying $6 call options, right? $6.50 call options that expired, in a week or two out. And that is making options market makers have to react and have to hedge immediately and have to spend a lot on hedging to get the stock moving up. Does that make sense?
So let's go back to the football analogy here, Matt. This is like when I see this chart, I'm seeing.
I'm the lineman. I'm the lineman in this chart. I'm the lineman and I'm the cornerback. You can run me right over.
Yeah. So I see this defensive lineman. I catch him. He's back on his heels. I'm the running back. I know I put my head down. I'm going to run right into you. It's not going to be too hard to knock you over. So if I, and in this analogy, if I had a giant trading group, on Wall Street Bets, and I just want to find a target to dummy, this stock would be a good one.
Relative to silver, it's a much, much better one.
It's an easier play to force around. So, to be clear, I'm not recommending anybody try this
Nope.
because you probably don't have enough money to make it happen. But the point is the same, right? Like we talked about this over the summer after SoftBank that I at the time had like half joked that like China or like North Korea could like start attacking, the financial markets with call options or whatever. And I didn't think it would be like a retail, GameStop operation that took place. But that's basically what happened in GameStop, right? They figured out that GameStop is a small cap stock. It didn't cost very much. It was $10 or $15 a share at the time. And they knew that they just keep buying these call options and basically force market makers to buy, right? So all those stars aligned. The question you just asked me, I would say go back to June and look at the stats on GameStop. That's sort of the playbook now, for what took place. And in Heckler, you can see there's a whole bunch of calls at the 6 strike, right? So I know that at $6, there's a lot of other call options sitting there. And so if I apply pressure by buying more call options, that's going to get the a tailwind for me, and I can get the ball rolling in the right direction. And once you have the ball rolling in the right direction, you can just keep adding call options and keeping the thing moving. Does that?
And one thing too, to Steve, to add on to that'd be interesting, is I was a portfolio manager for 11 years about a decade ago in biotech. So I was a fundamental guy. I did not trade based on technicals like this at all, but I traded a ton of options. And so there were days when I watched this happen in $100 or $200 million market cap biotech stocks, where somebody would say, oh, this company is going to get bought by Pfizer, right? So suddenly at 11 o'clock in the morning, I would notice I'd keep an open interest screen open. And I'd see that a bunch of calls were being bought, and I'd say, oh, they're going to jam this one. Then my instant messenger would next say, hey, Pfizer's going to buy this stock. And next thing I knew, the thing was up 50%. So these games have been going on for decades, but they haven't had this coordinated retail approach to it the way they do now.
Okay, so on your platform, do you guys have a screener that would show me where like I could find these like all green charts?
Yeah, we do. We have a scanner, and what the scanner does is it shows you all these positions, right? These are tables, which for our conversation here are not exciting, but we bucket everything, by these different metrics. So you could see, for example, which stocks have the biggest negative call game, which is essentially another way of telling you which stocks have sort of the most bullish stance. And a lot of these names you recognize, AMD and Microsoft and the like, which just have big call positions. But Vail is an interesting one. Nokia is another one with a very big call position. So you can bucket these things and dig in and figure out where these trades are, and we have a lot of subscribers that do that. But I also want to mention, this isn't an infomercial for us. If you're a trader at home, you can look in your brokerage system at your, where you trade your options, and you can see where call volumes are big and where open interest is big. That's something that you can do, with your brokerage platform, right? We just aggregate all that data for you and make it easier for you to parse through it, really, right? But you don't have to necessarily have, access to our material to figure this out.
Okay, got it. So let's look at one more chart here. Actually, I got two more. We got one more on the list here, and then I want to look at Sundial just for the heck of it. But let's take a look at GameStop.
Yeah, so we've done a bunch of articles on.
Ooh, look how red that is.
Yeah, look how red that is.
This is going down.
I'll be honest, I can't see a lot of these colors because I'm partially colorblind, but I can see that one for sure. That's bad.
So the GameStop has been amazing because despite everything going on, it's pinned options levels like to the T, really, really since February. And so what we see today is the biggest gamma strike is 45. And I believe the stock hit 45. I think it's around 46 or 47 at the moment as we're talking. But all this position expires, our big, huge position, chunk of the options for GameStop expires on 45. So what's been happening is originally this key gamma strike was 60 in the beginning of the month. The stock went from 200 down to 60 and it pinned 60. The next week, the key gamma strike went to 50, and the stock went down and pinned 50. Now the key gamma strike into tomorrow is 45, and that's where the stock is. And so what's happening is all of these big options positions that were built up over January, they're all just expiring, and the hedges are just unwinding, and the stock is slowly going back down. It's going to go back down to 15 or 20 or whatever, I'm sure is what I would imagine, really by the end of this whole thing. There's obviously the congressional hearing and things like that today, but this thing has so much weight on it right now. It would take a tremendous amount of force to make this stock go higher, based on the charts that you're seeing here.
Okay, cool. Let's do one more. Sundial.
Might be like 10 Elon Musk texts with different memes or tweets. Like,
yeah. So the sundial doesn't pick up in the scanner here. I'll have to check out why that is. Okay. Sometimes there's some funky open interest names that we can't model. So
sundial. So we're Jay and I we're from Canada, where we've seen a lot of these cannabis names early on play out. The reason I'm so interested in sundial is, one, it has a ton of social media traction, good or bad. There is a ton. And then two, it's got a low share price, which from our experience with retail investors, they tend to like, regardless of what it means to the overall market cap or shares outstanding. They tend to think cheap, good, expensive, bad, right?
Yeah. Right. Yeah. So here's ACB, which is Aurora. And remember, we looked at TLRY before. Remember, TLRY had like a very sort of red graph, right? As you can see here, it's orange and green. It's not. But if you look at ACB, which is, as you mentioned, it's cheap, right? It's when I say cheap, I mean it's only $13 a share. So the cost of one share is less than TLRY and some of these others. And it's a very sort of bright green bullish stance here, with the 13 strike holding all of the major options levels. And so what you can see is also interesting is you can see the call volumes here. These are the last 5 days of call volumes. On Monday, 300,000 calls traded. And then yesterday, only 80,000 calls traded. So on Monday, all these call buyers came in and jacked the stock price up, right? And the stock went crazy. The stock was up, I think, pushing 17, 18 bucks a share. And then all that call volume just died, and the stock immediately drifted kind of back down, right? So that momentum that everyone had built had kind of died off. And what I imagine is that on Monday, they're going to try to ramp it again, right? And when I say they, it's like all these short-term call buyers. So, these meme stocks are really popular because obviously the price is cheap. And they're in the news. Everyone thinks that the U.S. is going to legalize marijuana or whatever, and so they think, okay, there's a fundamental reason for us to, try to ramp these stocks, and they get the attention of the Wall Street bets kind of crowd, so to speak, and you could see that action come in every Monday and Tuesday morning.
So would the perfect setup be if it's all green and upward sloping? Like, do you ever see those?
Yeah, it's hard to get to upward sloping because these options get so far out of the money. But yeah, you can see an upward slope. Yep, you definitely can. But this is a very bullish setup. The pause I would say is that 50% of this gamma position expires on Friday, tomorrow night. So what we would want to see then is, do investors come in on Monday and do they buy 300,000 call options? Or is volume on Monday really big in calls again, right? Because if we know that call buyers are coming back in, then it's likely they're going to continue to keep buying calls, which gives us a tailwind, right? If we're going to look to own that stock.
So Jay, your heart is going to be broken here, but I think we should buy some Aurora.
Yeah.
Okay, perfect.
We live in a world where fundamentals seem to matter less and less. And I mean, the impact of options, I imagine, plays a large role in a lot of these names and why fundamentals don't matter so much, right? The more options that are bought and sold, as we've seen for the last hour, drives further buying or selling, right? So
yeah, it's you bring up like a really good point, right? I mean, and GameStop is the antithesis of that whole thing. I mean, GameStop, I don't know what GameStop is worth, but maybe it's worth $10 or $15 a share. It went to $300, $400, $500 a share, right? And that had nothing to do with fundamentals. That had nothing to do with anything other than options trading and short covering, really, in our view. And so a lot of these names now are becoming, you're just trying to front run or create momentum, right? It's drifted away from fundamentals. Now you can find names that, I mean, ultimately, if ACB is going to be insolvent, that's going to, the stock will reflect that, right? But in the short term, these options are going to have a really big impact.
So one question that I have, and I've kind of been thinking about the whole course of this show, is I keep thinking back to GameStop. So all these people were buying calls, but who was selling the calls so that they could buy them?
Yeah, that's market makers. So again, there's essentially 7 major market makers in the United States, and any time that you trade an option, even through Robinhood or Webull or whoever the system is that you're using, odds are that your order is actually being filled, right? The other side of your trade is a market maker, meaning that when you guys go and you buy your call, there's a market maker that's selling that call to you. And so they have big portfolios, right? Just like a hedge fund or any other big entity would have essentially a portfolio, right? They have a big position now of GameStop options, and they need to hedge all those options, to protect themselves from directional changes in the stock.
So I guess
And Jay, just real quick, their goal is not to make money off of directional bets.
Correct.
So they're providing.
Oh, absolutely.
Yeah. So the goal is for them is through the trading flows and volumes, they stand ready to buy or sell, and then they have to protect it at a ratio.
Yeah, I mean, to me, it just sounds interesting, right? I guess what it comes down to is the market maker is tasked with making the market for the equity, and that's why they have to do that. But to me, the simple solution was stop being the one that sells the calls. But I guess if you're bound by regulations that say you have to, you have to. Right?
That is absolutely the key point, right? That if you're what's called a DPM or designated primary market maker, you are required to be there and making a market, right? Now you can make a crappy market if you want, but you're required to be in there and make a market, right? They can't just say we don't want to trade anymore. They can't back off. So what they can do is they can make the options much more expensive, right? Like I can try to deter you as a market maker from buying a call by making the price just obscene, right?
Brent, could you compare the relative price of the GameStop calls when the squeeze started to later as an example?
Yeah, exactly. So I'll bring this. This is from our presentation on GameStop yesterday, but it addresses exactly what you were just talking about. So if you look at the just find this slide here quick. All right. So if you look at on 125, which was the day that, if you all remember, Melvin Capital, the hedge fund, had a margin call, and GameStop went from around $60 a share up to 150. The closing price that day of a call option, an at the money call, which means that if the stock closed at 75, you would have to pay $27 to buy a call that expired in 3 days. So that's roughly 30% of the price of the stock, right? A single call option. So it's expensive. That you have to add a 100 multiplier to your cost. So your actual cost for that's $2,700. Now, 4 days later on the 29th, when the stock was at $325, that same option, a 325, what we call an at the money option, costs $163. So that's almost 50% of the cost of the stock, right? Does that make sense? And that means that you have to pay $16,000 to buy a call option in GameStop. So what that's telling you is market makers were making these options more and more expensive to buy, but people just kept buying. They can't pull out of the market. They can make it more expensive, but people, I mean,
insanity is insanity at the end of the day.
Right. And what's kind of funny is, the put options were roughly the same price, right? They were equally as expensive. And what's fascinating we found about the GameStop, and this is kind of getting more of a technical discussion, was that people, and we think they were professional funds really, came in and they started selling put options. So you would think, wow, Brent, normally when the stock goes up really high, we would bet that people would buy puts, right? Because they think that GameStop's not worth $300 a share and should go back down. But because options got so ridiculously expensive, it made more sense to sell puts, right? To sell the bet that the stock is going to go down than it did to buy the bet that it was going to go down. Is that? Hopefully that translates a little bit.
Yeah, your question's a great one, Jay. It's exactly what Brent said. Is the relative cost of the call options were almost 1 to 3, and then they went up to 1 to 2. So they did change the implied volatility and the relative cost, but people just kept buying them.
And so what we've seen now after this GameStop thing, and a couple of these names, like TLRY was one that we were looking at the other day, that market makers seem like they're not messing around anymore. Like the minute that TLRY started to go crazy, was up around 50, 60 bucks a share, they jacked the prices of options up like immediately, right? They made them so expensive that we're like, oh man, like I'm not going to play around with that, right? So it's almost like their reaction now to like not wanting to get run over, like I think they were with GameStop, is you could see that them react much more faster now.
They're a lot more cautious while trying to do what they're required to do effectively.
Yeah, and so we have a kind of a cool chart here as well. This is the black line here, and apologies for people who can't see this, but the black line here is the price of GameStop stock, and you can see that starting in mid-January, all this blue spikes are all call volume. So this is all the Wall Street Bets retail crowd from mid-January up until January 22nd. We're just buying tons and tons of call options, and so that we believe that really loaded dealers up with having to buy stock if the stock went a lot higher. So that
Brent, our chart would have been green then. Go ahead.
Exactly, that would have been green. And then after Melvin Capital crashed on the 25th, it was all put buyers that came in, and we get into this on our site. Again, it's kind of out of the purview of what we're talking about here, but the point is that you could see these huge call volumes loading into the stock when it was under 50 bucks. And then so that way, when the stock started to move higher out of the 50 bucks, those call options all required market makers to buy a ton of stock to hedge themselves.
Okay, got it. So let's wrap it up there, guys. I really appreciate you taking the time to come on here, and
sure.
from the first time we talked to this time, it's clear that it's starting to sink in, and now maybe Jay and I can have some fun and try to pick a trade that we'll throw a little bit of money into and see how it goes based on looking at some of these charts. But
just remember, green is good, red is bad. Just start there, and
then you guys do make it very simple. So thanks so much for joining us, guys. I hope you'll come on again, as I'm sure that this isn't the last week we're going to hear about options and the importance of analyzing them if you're a retail investor, because with Robinhood, it's not going away. Retail investors have access to these things. It's only going to get more important, I think, as we move forward. So I really appreciate you guys taking the time and everything that you guys sort of educated us with thus far.
It was a lot of fun.
If you guys ever wants to pop on and just talk about a specific stock one day that's an options name, let us know. We're not afraid to stick our neck out there and tell you what.
Put us in a 5-minute time box, so we'll
Awesome. Thanks so much, guys. Really.
Thank you, guys. Appreciate it.
Thanks, Jay. Talk to you guys soon.
Okay, so let's wrap it up here, Jay. I don't think we've got a ton of news that I want to get into today. What do you have going on at the dive this afternoon?
So this afternoon, we've got some stuff going out. It's been a morning. Who do we got this afternoon?
Who do we have coming on video?
And I can tell you. Just give me 2 seconds. I gotta find the right conversation.
Your mind is all like entangled.
My mind is fried right now.
First and second derivatives.
Yeah. So we have Will Rind. That's who it is, and I apologize for forgetting. It's been a very busy day. So we've got Will Rind on. He is from Granite Shares. We did have him on SmallCapSteve Live previously, and now he's sitting down with host Cassandra Leah to go over his take on inflation, small caps, ETFs, and everything in between. It's a great little interview. It's about 10 minutes long. After that, we've got some job numbers going out. Some people may have heard of it already, but still not the greatest job numbers south of the border, and it kind of points to a lingering issue that we're seeing in the jobs market as a whole. On top of that, I don't know that I got anything from young Justin this morning. I know you sent him an article to work on, but I don't think he's getting anything done.
I was debating sharing that, but I'm not going to. Justin's a serious guy.
Yes, he's a very serious guy. Aside from that,
he's got this from our producer Chris. Justin couldn't come on because he has exams today. Chris, our producer, is now monitoring Justin's exam schedule apparently.
But am I allowed to give a disclaimer, or is that you today?
Well, let me do it because you're looking a little bit. Oh no, okay, you can go ahead. Before you were looking a little potatoy. Now you're looking.
Well, now we're getting the camera.
Now we're getting the full J Lutz.
Anyways, so today was entertainment purposes only. Anything said by any of us that were on the show is for entertainment and purposes only, strictly opinion. None of us hold any licenses that I'm aware of or financial designations. It is some great content, but again, it was for entertainment purposes only.
Okay. And Jay, just want you guys to know that he's now a bull on Aurora, ACB.
I will say I was a bull once upon a time for that one. I was in at 40 cents back in the day. So
well, look at you. I'm sure that you made a lot of money off those 100 shares.
I paid off a credit card, so it wasn't that bad.
There you go. Well, thanks so much, everybody, for joining us today. You could have spent your last hour looking at any screen, any place in the world, but you chose to spend it with us, and I appreciate that. Tomorrow, we've got a turd joining us, Mr. Turd Ferguson from TF Metal Reports. It's actually Craig Hemke, who's like just hilarious. And I was so excited when I looked at my calendar and I saw Craig Hemke was listed tomorrow. I'm really excited about that one. He is absolutely a hoot and has great insights on all things monetary and macro. So join us tomorrow, and thanks to the Spot Gamma guys for joining us today.